There are different ways to look at a property and underwrite it, right? There's obviously, like you said, these investments exist on the financial side. On the analysis, you want to look at the numbers, make sure that the opportunity is there in order to add value, in order to really actualize whatever your investment thesis is.
Welcome, everybody, to today's episode. I'm your host, Nathan Loy, and today we are joined none other than Viking Capital's very own Judah Fuld. So, Judah, welcome.
Hey, thanks, Nathan.
So, Judah and I work really closely together on the acquisition side of the business. But, Judah, I want to get kind of your backstory, and then we can dive into what we do together and how we find deals.
Yeah, no problem. Happy to share a bit of my background. So, like a bunch of other folks here at Viking Capital, kind of came to real estate as a secondary career when I kind of really saw my passion for it and interest in it. And then I think, not so bad at it. So I was happy to kind of combine all those things into a job. Been here about 3.5 years, but beforehand, I started on the legal side of things. So I graduated law school 2010, kind of a crazy time to graduate anything. Immediately was working in criminal defense, civil litigation. So I was running around courthouses in Manhattan, the Bronx, Queens, New Jersey. Not for me. I knew pretty early on that I was kind of more inclined to numbers and analysis, and it wasn't really paying dividends or coming in useful, in the courtroom. Moved down to Maryland when my wife got a great job here and started working for a law firm that actually practiced a lot of real estate law. Once I started talking shop with my client about their investment strategy and their thesis, and they did retail, some industrial, some multifamily as well. I just knew it's where I wanted to be. I really loved the puzzle aspect to underwriting, the way to unlock value, and especially on the multi side, the ability to really not just work with kind of financial instruments and create value for investors, but improve the life of the tenants on site as well. So knew that's where I wanted to be, jumped around in investment sales and kind of capital markets advisory for a little bit before landing on the buy side and the investment side with Viking Capital, where we've thankfully been able to acquire a number of properties. We've transacted on more than 5,000 units, and that's multiplied that times tenants turning over average every 1.5 to 2 years. That's 15,000, 20,000 probably tenants we've been able to help out.
Wow, I love that. So yeah, Judah and I have worked closely together on the acquisition side of things. We've underwritten hundreds of deals together. At this point, it might even be thousands. But when I first started underwriting, I was very much in the weeds of focused on the numbers and pretty much the numbers alone. But Judah, to your credit, over time, you start to kind of get a sense of the story of the property, the health of the property, the opportunity that lies ahead, what kind of debt can be placed on it. So can you, describe to our audience what underwriting is and how it kind of helps set the backbone of kind of the future performance of the property?
Yeah, absolutely. Similar, there are different ways to look at a property and underwrite it, right? There's obviously, like you said, these investments exist on the financial side. On the analysis, you want to look at the numbers, make sure that the opportunity is there in order to add value, in order to really actualize whatever your investment thesis is. But at the ground level, these are places where people live. We're looking to improve the quality of the property, and there's definitely a financial component to that. But once you get on site and you start touring properties, you really start to see that, hey, this is the place where people live. How can we help improve the quality of the life on site? And thankfully, in this business, usually alongside that comes the opportunity to also raise the profile of the property, which comes along with raising rents and all that. So, I would say most people who are listening and watching this podcast will have had some experience in their life, right? If you have the good fortune to be able to buy your own home, then you've done some sort of financial analysis where you've said, hey, I want to buy a home. Either I'm going to buy all cash or I'm going to finance it with a bank loan or fair housing loan, either way. Or if not, maybe you're rented because you want to rent, or maybe you rent because you've had to rent, but then you're actually more equipped to get involved in this because you walked through rental property, probably more than one in your life, and you've sized up the management team, you've sized up the property on site, what are the amenities, what's my quality of life here relative to the properties around it, relative to how much they're charging for rent, right? All that's actually a lot more intuitive than people realize. So yeah, number one is how's the neighborhood? How are the schools? What are the jobs? If I live here, where will I work? Right? These are jobs that you can ask yourself. You want to live in an apartment. These should be the first questions you ask yourself when you're looking to invest in a property as well.
Absolutely. That makes sense. And when you're looking at, a property, a lot of the underwriting is based off of assumptions because, we typically get the financials from the seller, and those financials are pretty much, handed out to all potential buyers, but it's kind of the assumption that different ownership groups will place on those financials based off how they operated in the past, based off of the market. So can you kind of walk us through what the typical assumptions are in any sort of underwrite?
Yeah, listen, every group and every investor over time will formulate their own assumptions, right? I'll tell you one thing: I never assume that I'm smarter than the last guy, unless I have a reason to think that they were maybe operating inefficiently or inappropriately. So yeah, you get the financial statement, the trailing 12-month operating statement, which will typically include all the revenue line items that come in, rent, what kind of numbers have been impacting rent to not achieve its full capacity, vacancy, concessions, delinquency, and bad debt, and then other income items, right? You're going to see what they've been charging by way of either reimbursing some of the utilities, if there have been fees that have been charged, pet rent, those types of charges, and then all the expenses it costs to operate a property, not including capital expenditures, that's something separate. But generally, what's it cost to keep the lights on? What does it cost to take the trash out? What does it cost to keep, pest control and all those kind of things? Generally, if you're buying from a seller who you think is reputable, or you've heard their name, or they own a number of properties, generally it's a good baseline to go off of. Now, again, nothing should go without scrutiny. That's typically a good baseline to go off of. And you can then just look at them more broadly, right? Okay, let's kind of, the more you do this, the more you get a sense of what should it cost by way of all my leasing costs, right? So to pay for maybe the bonuses if you classify it as such, or for advertising, marketing, any events you might run to try and draw attention to available apartments in your community. And you get a sense, hey, it should cost me about this much per unit or per year. Then you look back at what you've been given. Are they high? Are they low? Are they in market? Is there an opportunity for me to actually lower an over-expensed line item? Or maybe on the flip side, maybe they're under-expending and it's actually going to cost me more. So I think a lot of these things, you're right, they're assumptions, but things that you'll build up over time. If you're a new investor, what you can easily do is there are many groups and associations and trade groups that publish kind of baseline figures as to what to expect and what's kind of quote normal. Go off that to start, but soon you'll start really making your own assumptions.
Yeah, I love that. And that's why we work so closely with the asset management team too, is when we make these assumptions on the front end, we want to be able to pass off kind of a similar asset to the asset management team that then can capitalize and really work with the business plan that we've set up on the front end of that analysis. Like in an ideal world, you wouldn't really have any assumptions in your underwriting. They'd all be data-backed points that are kind of guesstimates rather than just blanket assumptions. So, part of underwriting is seeing if it makes sense as an investment, right? Does the property that we're buying and the price that we're buying it at with the debt that we have, does it make sense as an overall investment? So what kind of return metrics are you looking at? And then how can you tell, quote unquote, good return from a quote unquote bad return?
Yeah, absolutely. Again, so happy to get in what Viking looks for, but I think, generally if someone's trying to educate themselves on return metrics and what makes a quote good investment, it's a personal decision. And the first thing that someone has to really know is it their own money or is it their investor's money? Because if it's an investor's money, then whatever the investor's looking for, then that's the metrics you're looking for, right? But that's an easy out for me to say, so I'll try and dig in a little deeper. The truth is, first you have to decide, one thing that really governs return metrics is cost of capital, right? Oftentimes you're borrowing money, either from investors, and you're kind of seeing what returns they need, or from a bank where you're paying interest on a loan, or yourself, right? There's also the idea of opportunity cost of capital. Hey, I could put this money into real estate, and thankfully I have all the money to do so. Or if not real estate, I can put it into the stock market. I can put it into crypto. I can put it into treasury bonds, whatever you want to put it into. So at some point, you're looking at either what it's literally costing you to have this money in your hands because it's coming from elsewhere, or what you could be doing with the money, at a lower risk premium for the same, if not better, returns. Generally, once you get past that, the next question you ask yourself is, well, what's my goal on this investment? Right? Am I looking to kind of quote flip a property in a number of years, raise the value where it's the steepest part of the curve in terms of how much the spread between buying and selling? Because ultimately, as fancy as you might want to get into the details, ultimately this business is buy low, sell high, right? So if you're looking to flip it, then some people try to say, hey, when I add the most value in the first 3 to 5 years, I want to get in, I want to get out, then recycle my money to the next deal where I can do the same thing. In those cases, you're really looking, it's an IRR driven, right? An IRR is basically average annual return that's weighted by the time value of money. So there's again, a time value of money. So if the shorter the investment, the bigger bang you get for your buck, then you can recycle it elsewhere. Some people are saying, you know what, actually, I want to buy and hold forever. I want to buy in real estate. I want to start really amassing a huge portfolio of passive income. So I really don't ever want to sell. All my kids can inherit the properties. Let me set my kids up for life and they can set up their kids. I want to, have a massive portfolio and become a family that lives off real estate. Okay, great. Then you're never going to sell. You're never going to get a huge bump. So you're cash on cash driven. Hey, what's my money doing for me on a yearly basis? Then you're looking at cash on cash, right? How much money your money is generating. So again, those are really what's going to drive the returns any specific person looks for.
Yep, that makes sense. And that'll differ by operator, by property type, by location. And ultimately, at the end of the day, those returns are just a risk and return analysis. A lot of the discussion, especially in today's topics of pricing and cap rates, revolves around how do you project future pricing, especially 5 years out. So can you kind of explain what a cap rate is and the general rule of thumb for determining what a property could sell for in the future?
Yeah, absolutely. So anybody who's looking to buy a property and part of their business plan is to actually sell the property as opposed to holding it. If you're going to create your pro forma or you want to understand what kind of value you create, then you have to know what you're going to buy it for. And yes, you want to understand what cash you're going to generate during your investment, but then ultimately you want to know what you're going to sell it for. Now, a cap rate, it's really a capitalization rate, or it's a way to try and compare apples to apples between different investments in real estate, right? You could have two properties side by side on the same street, built by the same developer, so carbon copies of each other. Yet they can trade for very different pricing. Unlike a single family home where everything is sold generally, for if it's going to be owner occupied, empty, the person's going to live in it. On the commercial side, you're buying an income stream, you're buying an investment. So if in the first of those two identical properties, it's fully occupied and getting top of the market rents, it's going to go for one price, right? And in the second property, let's just say it's 75% occupied and rents are way under market. Well, it's going to sell for a very different price because the revenue is much, much less. So that relationship between revenue and income and pricing is called the cap rate. The cap rate is simply the annual NOI, so net operating income, operating revenue minus operating expenses, divided by the value of the property, typically at the price when it transacts. Now, again, in those two scenarios, though, you want to be able to compare, well, which one of these investments is less risky, right? So often the cap rates will reflect a measure of risk. The more risky an investment proposition, then the higher the cap rate is going to be. The more revenue you're going to want to see relative to the price. So a core new property that's trading in the center of town, the most desirable area, that's fully occupied, brand new, nothing to do to it, that's going to have the lowest cap rate because you're taking on the least amount of risk. You don't need to spend money on it, right? You don't need to attract people to the area. They're already attracted by the fact it's in the middle of town. Whereas if you go to maybe a C area where there's maybe some crime, the property has some structural issues, there's a lot that needs to be done to the property in order to really curb that risk. And some of the risk you're never be able to curb. Like I said, if there's crime in the area, that's seemingly uncontrollable. That's going to trade at a higher cap rate. You're going to need more money relative to the same price in order to justify making that investment. So that's kind of a quick primer on cap rates. Now they're important though because kind of the cap rate given a certain risk profile is then how you back into pricing. So let's say you look at a property and it's got a certain income stream. So, well, what should I pay for it? Well, generally, this kind of property and this kind of risk profile in this kind of area has been trading for a certain cap rate, maybe a 5% cap rate, a 6% cap rate. You can use that as a benchmark to what is a fair price to the market, what to expect, because you know the risk tolerance of everyone else in the market, what they've been spending on those kind of assets. Now, to get back to your question, because this has been a very long answer to your short question, On the sales side of things, you need to say, hey, if I'm buying to this price, when I sell it, what's going to sell for? What's the market going to be? So the way you do is you know what your income is going to be. You have an idea of, hey, here's what rents are now. I know based on comparable properties nearby, if I fix up the interiors of the units, I put in, granite countertops, because the rest of the apartment's all granite in the market, and this one still has Formica. If I put in plank flooring, because everyone else has plank flooring, and this one has carpet. And for all those reasons, and I let's say put in new pool furniture, and I fix the parking lot so it doesn't look like a war zone, then I should be getting the same rents everyone else does in the market. Look, you know exactly where your rent's going to grow to. Your operating expenses will go up, maybe with some inflation, but generally shouldn't be a huge change. So you have an idea based in 2, 3, 4, 5 years what your NOI is going to be then. So if you have an idea what the cap rate is in the market, you can then apply the cap rate to your NOI and now know what your sell price is going to be. Now, that's assuming you know what the cap rate is. So I think your question was how you determine that cap rate. Well, you know what you bought it for. And the past couple of years, it's been really volatile with kind of cap rates. But the rule of thumb is to spread at 10 basis points every 5 years. So what you're doing is you're not going to bank on appreciation. Hey, I think cap rates are going to go down. And if cap rates go down, then your value will go up. It's happened over the last 10 years, although it slowed down the last year and a half with interest rates changing. So if you want to really just know what's a good internal value added deal based on the actual changes you're making on the ground, what you're raising rents, we typically keep the cap rates flat, if not raise them a little, to just have some cushion there. But that's kind of the summary of what cap rates are and then why they're so important when estimating your exit value.
Got it. Because ultimately that value is determined by the income that the property is producing and then what the next potential buyer is willing to pay for that asset, given the location, the debt kind of market at the time of buying. So that makes perfect sense. What are some red flags that you often see in underwriting that investors should be aware of?
Yeah, I mean, listen, there are always things to look out for. You never know what all the red flags are going to be, and then those are the ones you can't really plan for. But there are certain ones you always want to pay attention to. As I mentioned, the first thing you're going to get, or one of the first documents you'll get from the broker or the seller, is that trailing 12 months operating statement, right? So it's very easy to say, hey, this is what the guys have been operating at for the last 5, 6, 7, maybe even 20 years. Right. And the guys, they're brilliant. They know what they're doing. They're an institutional shop. I can't do better than them. And maybe you're right. And your assumption may be, let's just keep going with those assumptions, right? They know what they're doing. However, certain things will almost always change, right? One of them being, taxes. So for example, tax is a number that you really have to be cautious about because on the commercial side of things, not too dissimilar from the residential side of things, right? Your taxes get reassessed based on the comps in the area, what they've been selling for, and what they think your house is worth. Same thing on the commercial side. If you have an apartment building, if they think the value has gone up tremendously, then they're going to raise taxes commensurate with that increase. With what's happened over the last 10 years, if you're buying from someone who bought a property last year, well, values have stayed flat, if not come down a little. So maybe not so worrying. Let's say someone's owned it for the last 10 years. There's a good chance this property has tripled in value. Right? There's a good chance the taxes might triple in value. And we're talking about 10, 20, 30, 40, or $70 million properties. You can be talking about hundreds of thousands of dollars a year extra in expenses. So it's one thing to be very, very cognizant of.
Got it. Yeah, for me, it's always an analysis, again, going back to the risk and return of, what are they placing their assumptions on the income side of things and then same thing on the expense side of things. So if I'm seeing incredibly high, potentially double-digit rent growth, that could be a red flag. Likewise, if you're cutting down the expenses to operating at a 25% expense ratio, similar kind of vein where you're not underwriting the property accurately. Yeah. So, if investors are looking at a operator's underwriting for the first time, are there any key things outside of that T12 in terms of assumptions or kind of overall underwriting thesis that they should be taking note of?
Yeah, as you mentioned earlier on, I think you want to get an understanding of what's going on, right? It's very easy to immediately dive into the numbers, right? But my first conversation is, hey, what's the backstory here? Who's the seller? Why are they selling? Right? Sometimes they'll say, well, listen, they're a fund. They have a 5-year life on their fund. It's year 4. They have to sell. Okay. That's a nice answer. And it may be true. But sometimes there are other reasons. Well, there's a partnership dispute, or you get a story that may be convoluted, or you just get a story that can give you some insight into what's going on in the property. So I would say kind of really just getting the backstory, try to understand it, put yourself in their shoes. Does that make sense? Would you make the same decision? Okay, they have a partnership dispute. Do they have to sell? One could buy the other out, right? So this can all kind of give you some insight into what's going on.
Yep.
So, and the other thing is, listen, we look at a lot of properties and we can't get to every single one right away, but having that tour is really crucial. The pictures in the broker's package may look beautiful. I always joke with you, Nathan, that if you ever see a picture taken at twilight, what does that mean? It
means that they're hiding something. There's got to be a better picture they could have found.
Every property looks good at twilight, right? But the idea is get there and get on site. You can see, the car profile. You can get a sense of the tenants. You may even meet a couple of tenants. You can talk to people in the neighborhood, get a sense of the reputation of the property. We always do, in our checklist, we have a Google search, right? We look at the Google comments, and how many stars it has. All these things are relevant. So all those things are crucial in addition to the numbers to really try to get a sense of what's going on site and what's the opportunity for the next guy.
Yeah, that's what I look at, especially during the early phases, because it doesn't make sense to spend all your time underwriting every single deal that you see. So even before we dive into the numbers, the pro forma, kind of what the actual quantitative data is showing us, I always like to dive in and say, hey, does this story make sense? What is a story? Is this a value add type play where you're doing interior and exterior renovations? Is it more kind of a core plus play where there's kind of other income opportunities? What is a thesis of the story given the location, given the demographic that it's serving? And then once I'm in agreement on that front, then we can dive into numbers and see if the numbers support the thesis. But you kind of have to have that 30,000 foot view off the bat. So, we've seen a lot of changes recently in the real estate market, prices and debt specifically. What kind of market fluctuations do you expect to see in the coming years? And then how do you expect to adjust, Viking's underwriting strategy to incorporate those changes?
Yeah, no problem. Well, the run that we've seen from, the Great Recession in 2008-9 up until about a year ago was really unprecedented in the real estate market, right? Rates kept on going down. They were historically at their lowest point for almost a decade. At the same time, this housing shortage really started to become a problem, and the rental markets seemingly grew and grew and grew, kind of culminating in the surge in rent growth, between 2020, really in 2021. So I think that we're going to have kind of a return to normal. When I talk to a lot of other operators and other ownership groups and a lot of the institutional funds, we're going to go back to, a 5-year business plan really being a 5-year business plan, right? Most people at 5-year business plan exit in year 3 because they got their exit pricing, and you can lock in your exit without 2 years more of risk. So I think you're going to have, kind of return to that 5-year business plan where it takes, more actualization of the original thesis in order to get every dollar, in order to really successfully execute an investment. Additionally, I think that because of this run, so many people enter the market that in the major markets, I don't think you're going to have as many truly value-added plans available, right? Almost every 70s, 80s, and 90s property out there was bought and sold a couple of times, put through some sort of value-add process where things are renovated, and the amount of properties is just, the volume is not there. Now, I think that some groups, though, are saying, I'd rather take less of a value-add opportunity in an Atlanta or a Tampa or a Phoenix, where there's just been so much population growth. So you'll still see people transacting in that market. One thing Viking has started doing is Viking has started looking in the Midwest, major U.S. markets that over time have shown really steady job markets, steady economies, and never showed surging rent growth. But because of that, there is actually more room for stable rent growth, and that same 3 to 4% every year. And they have not been as tapped by the real estate investor market. When everyone was looking at Atlanta and Tampa and Phoenix and Orlando, they weren't necessarily looking at Indiana or Missouri. And these markets where you have, again, people have been living there for a lot longer. They're major U.S. economies with a large amount of supply in the market. But I think you have a lot more properties that are in need of those value add opportunities where tenants would be happy to take the dollars they're earning in a major US economy market and pay for a nicer, place to live. So I think that's one way that we're going to try to incorporate some of this by kind of looking at those more neglected investment opportunities where, again, if you're a good operator, if you can treat tenants well, if you can find a property that really has the opportunity therein, that we can capitalize on it.
Yep. And kind of the whole goal is to be as nimble, but also accurate as possible as these fluctuations happen, to really kind of incorporate them, knowing that, nothing is really steady. Everything's cyclical. So the way that we, as you said, to kind of underwrite at Vikings, we take, a high level view of the property. It doesn't work from our deal criteria. It doesn't meet the vintage that we're looking for, the number of units, the markets that we're looking in. Then we do what we call kind of a quick analysis, a 10-minute kind of back of the napkin sniff test to see if it passes the initial numbers. And then we'll go in and we'll fully model it out in our own Viking model that really kind of flushes out all of the details. But the goal of kind of that underwriting process is to be as streamlined and as efficient as possible, where you're not spending time on deals that you shouldn't be spending time on, and really spending time on the ones that do work. You want to get kind of a more nuanced perspective on, so you can make the strongest, most accurate offer. So with that, how do you and kind of Viking as an acquisitions team, how do we incorporate technology to help with that underwriting process?
Yeah, no problem. Like I said, things have gotten so competitive over the last 10 years where I'm assuming like 10 years ago, you were able to have a couple guys in a room, sift through the markets that you like, be one of a handful of groups interested in a property. The competition has increased so that we have to look at over 1,000 deals a year to really find our 48 deals that we can, get awarded and begin our ownership on. There are a few things that we've done, which I think, they're scalable, whether you're someone who's looking to invest passively, whether you're looking to really start your own investment shop in some way or shape or form, you can really incorporate some of these into it. So like I said, let's start from the beginning, right? When you're going through the deals, right, it's very easy to try and get into the weeds on every deal, right? I don't want to miss anything. Right. There's like the 80-20 rule, right? 80% is going to come of your success will come from 20% of your efforts. There simply isn't the time to, start, touring every single property that comes to your inbox. As you had mentioned, some sellers are really motivated to sell. They're going to meet the market. Other sellers may just be testing the market and throwing a crazy price out there. Either a broker promised to them, or they're just saying, hey, maybe I can get my price and sell. Maybe I'll hold on to it. Early on, you'll see based on simply the cap rate analysis we said before, like, wait a second, they want this price. The NOI they're showing me, which is probably their best case scenario, is that number. That doesn't make sense. That price is way too high. No matter what I do, it's not going to work. Okay, let's pass on that deal early on. So just that idea of let's focus on the ones that make sense will save you a lot of time. In terms of kind of how we use technology, there are a lot of computer programs out there, whether they're Excel models you can build, you can buy. We work with a company that's called, Red IQ, happen to give them a little plug here, that offers a way to kind of take a lot of information and they offer a back of the napkin type calculator. Also allow you to slice and dice the rent roll by just uploading it. Again, it'll save you a lot of manual labor and it'll let you to see kind of some of the really crucial points. What are the average in-place rents? What are they calling market rents? When you look at the comps nearby, you can kind of get a sense really quickly of what opportunity there might be. The other thing is there are companies, there are part-time analysts. There's really a lot of people and resources where someone can really supplement their own efforts. There are companies that work out of India. There's a website, Bullpen. We have a lot of people looking for part-time analyst work. Or if you're looking to scale and looking for more simply manpower hours, there's a way to start looking at more deals and kind of getting a good sense of them before you take that deep dive to know which ones to focus on.
Yep. And I think that's only going to increase too with kind of the whole AI talk that's coming down the road of, further automating things and having more optionality. So we talked a lot, Jude, about the things that affect an underwrite. We've talked about, cap rates. We've talked about assumptions. One of the last things I want to touch on is debt. Can you kind of go over, the different debt options that are out there and what might be more applicable to certain kind of deals than others?
Sure. So not too different than when you buy your own home or when you buy a car, right? So most times when investment groups are buying properties, and again, some are buying all cash. Usually you're getting a loan from somewhere, and I'll go into a minute the kind of the various options that are out there to help you buy the property, and you're getting anywhere from 50% of the purchase price to 75% of the purchase price. Typically, certain lenders will actually lend you some of the money that you need to do the capital work, right? To do the renovations, to fix up part of the property as well. So not too dissimilar from when you're buying your own home. Now, there are really two benefits taking on the loan, right? One is exactly like when you buy your own home. You don't have all the cash to lay out, right? So hey, could someone give me 50, 75% of the money? That way I can actually buy the property. That's reason number one. Reason number two, though, which is a little different when you buy a home, is something called leverage, right? You're going to try to actually amplify your returns through borrowing and through the debt. Now, the way that works, and again, this can be a whole webinar unto itself on the benefits of leverage, the dangers of leverage. The benefit is that if you're borrowing from a bank, let's just say that the money's costing you 5% a year. So every year you're paying 5% of what you buy. So let's just say you borrow $100. Every year you're going to pay the bank back $5. Now, on that $100 that you spend on the property, right? If you're getting it let's just say you're getting it at a 7 cap, so you're earning 7% on every dollar it costs. So that $100 you borrow, you're going to make $7, and you're going to pay the bank $5. You essentially made $2 from money you didn't even have. It's a way to increase your returns. That's the leverage side of things. And the downside, though, is if the property for some reason is not performing, right? When you buy it all cash, you owe the bank. So you don't have the money. No money comes in. You buy it for $100. No money comes in. You don't make any money that year, that month. If you borrowed $100 and you don't make that $7 you thought you'd make, but you only make $4, well, all of a sudden now you owe the bank $5. You only made $4. You got to come out of pocket, or you might get foreclosed on, right? So that's the risk element to leverage. It's definitely a double-edged sword, but used properly can really be creative and help really amplify your business plan.
Interesting.
I'm happy to go into a moment just really briefly. There are the agencies. There's Fannie and Freddie out there in the government that put out money for these kind of deals. You have life companies they set on all this cash, from the insurance plans they put out. They're looking to invest their money, so they'll put out loans. You have local banks that look to invest usually more in local properties, and they'll put out loans as well. And then you have what's called a bridge loan, which is let's just say you buy a property that's nearly not financeable. It's falling apart. It's vacant. Any bank looks at it and says, well, we're not going to lend on that. It's way too risky. There are bridge loans that'll come in. They're higher rates, short-term variable loans that will say, hey, you get that property fixed up, and then we'll give you a short-term loan. And then once you have the property in better shape, it's now occupied, you fix up all the physical problems with it, then one of the banks or the agencies will come in and say, now we'll lend on it, and you pay off that short-term loan. Those are kind of a quick summary of a lot of the borrowing options.
Yep, that makes a whole lot of sense. And on the fixed side, you typically have, lenders that are lending on loan to value. So they're shaking in terms of just the purchase price itself. But with that fixed rate debt, you also have, potentially some high prepayment penalties when you go to sell the property. Or on the reverse side, if you go the bridge route, they typically lend on something called loan to cost. So not only will they lend you on the purchase price of the asset, but they'll also lend you on your CapEx dollars, which are kind of your larger projects. But you typically don't have those prepayment penalties when you go to sell. So it's always kind of that give and take, and really it's about finding what type of debt will fit that property the best, given the business plan that you plan to execute, right? Given your hold period and the kind of leverage that you're looking for.
Yeah, better knowing your business plan will really help inform what kind of debt you take on.
Yep. And also wanted to note that the underwriting as kind of a process isn't anything that is stagnant or set in stone, right? The whole kind of point of the underwriting process is to be fluid and to incorporate new data as you get to it. So, when we do due diligence, for example, we're incorporating that data into the underwriting, into the overall business plan of that asset. And so something that we do is that we incorporate sensitivity analyses into our underwriting. And essentially what that is a way to say, hey, we're not necessarily married to the exact assumptions that we have. We don't know what the cap rates are going to be, right? Get to your point, Judah, that 10 basis points for every year that you hold it. So if I'm buying, a property at a 5% cap, typical rule of thumb, if I'm holding it for 5 years to sell it at 5.5 cap, is that, hey, there could be market fluctuations in the future that we don't know about. So we put in these sensitivities analyses to see how those different variables would affect returns throughout the whole period. So, if you could give one piece of advice to an investor who's reviewing, either an entire underwriting model or just looking at the pro forma or kind of basic assumptions of an operator for a deal, what would that piece of advice be?
Yes, if you're someone looking to invest passively into another operator's deal, I would say be very critical of a few things. One, IRR, overall returns on if it's let's say it's a buy and sell type of hold, whether it's 2, 3, 5, or 7 years. The back end sale really drives a lot of the value, right? So take a look at, hey, what kind of cash on cash is actually producing? And then you'll see, well, is it coming from the life of the investment, or is this really kind of a flip on the back end? And that's not good or bad. Just get a sense of what type of investment it is. But then also you got to look at what kind of cap rate they're putting on the exit. What are they assuming when they sell? It's very easy to inflate the back end number by overvaluing what you're going to get on exit. So that's one thing I would just say. If you're looking at a model, if you're looking at the numbers strictly, that's one thing I would really look at. And the other thing is, if a plan where they're going to be renovating units and getting premiums, take a look at comps. Thankfully through apartments.com, right? You could very much see in an area what rents are going for, and you can have an idea of if their business plan looks real or not. Like I said, most people here have rented, either are renters or have rented at some point in their life, and it doesn't take too much to say, hey, this property is in this condition. They want to raise rents to this number, but this property next door is in much better condition, and they're getting those high numbers. Great. You might look at the properties down the block and say, well, they're getting the same low numbers, even though they have these beautiful interiors. Well, maybe this business plan is not going to come to fruition. So, combination of common sense with a little bit of work can get you a quick sense of what's going on.
Yep, that makes a whole lot of sense. And that's something that we see too, where there's what's called an in-place value add plan, where they've already kind of, renovated a small percentage of the units, might be 10%, 20%, 30% of the units, but they've already shown that proof of concept exists in that market and that those higher level of renovations are garnering those higher premiums. So for me, it's always about, asking yourself why. Why did they place the assumptions that they did? Why are they using that debt? Why are they projecting these certain premiums? And if you can, you don't want to go down their whole route of analysis paralysis and spend, yourself asking 1,000 whys, but eventually you're asking yourself those questions to say, hey, given all the information that's being presented to me and given, my own kind of knowledge, does the risk and return profile make sense for the price that they're purchasing at and the return that they're giving for that specific asset? So any final, words of wisdom for our listeners, Judah?
Yeah, I would say that most of our viewers and listeners are better equipped to do this than they might think they are. Like I said, as opposed to industrial or retail or hospitality, actually maybe not hospitality, but not everyone here is operated a warehouse. Not everyone here has, had a barber shop and a retail strip, right? Most people here have rented. The way I think about it is, when I was taking the bar exam and we had to study the family law section of the bar exam, the professor came in and said to us, listen, I'm not sure how many, to all of you who, have, both parents, you had siblings at home and you had a nice home and a white picket fence and 4 grandparents, and your parents never fought and you and your siblings still get along and there's never any sort of dispute with grandparents over wills or money or anything like that. You're in a lot of trouble right now. But the rest of you, right, which is most people who've had some issue in the family, you're going to get it. It's just going to be intuitive. So most people here didn't grow up in a home and immediately go buy their, $10 million home. Oftentimes someone has either financed the home themselves, they've rented an apartment or a couple of apartments, they've been in a fight with the landlord at some point, right? You're really better equipped to understand the general situation on the ground on a property than you might think. Combine that with some simple analysis of numbers, and you can really get a lot farther than you think when analyzing an investment opportunity. So I think have a little more confidence in yourself. Feel free to find a good partner when you trust. Thankfully I've been at Viking a while. I used to have conversations with every investor in every deal. Now we have a fantastic investor relations department, but I still have the opportunity to talk to investors who want to have a chat with the guy who's running the acquisitions, and I'm happy to do so. And that transparency, I think, goes a long way, right? If you're ever told, no, sorry, you can't see that, or you can't have that conversation, those are red flags intuitively. They're probably a red flag in the investment as well.
I love that. I love how you always look at kind of a deal from a 30,000 foot view, Judah, and then can simplify it down and really kind of focus on the simplicity of things. Because you're right, like innately, we do understand multifamily, I think, a lot better than some other asset classes. And it's great. There's this great quote by Tony Robbins that says, complexity is the enemy of execution. So if you get too complex, you get too in the weeds, it can kind of muddle the investment, where I think boiling it down to just, hey, does this investment make sense? Various kind of simple terms from what we just discussed is kind of the best way to at least start. And then you can dive into the underwriting and the numbers and see if it kind of validates that thesis. So
right. There's easy and there's simple. I'm not going to say it's easy, but it's more simple than you might think.
Yeah, I love that. I appreciate it, Judah. It's always a pleasure. I'm sure this won't be the last underwriting discussion given what's coming down the market. I appreciate you taking the time and your knowledge on how you're looking at deals.
Absolutely. Happy to share.
Thanks, Judah.